Hello everyone, this is the first Bitcoin review of the new year 2026. The next ones will be about the stock market and cryptocurrencies. And I wish that this year will be as prosperous as possible for you and your loved ones, bringing lots of joy, love, and the fulfillment of your plans. Let's take a look at the Bitcoin chart that we discussed on December 24th. At that time, I mentioned that we had every chance to reach the 50-day moving average. It's shown in green on the chart. And as we can see, we broke through the 50-day moving average and moved up to the upper boundary of the range, which is marked with a white rectangle locally and with a yellow one globally. The yellow rectangle is drawn from the February 2025 low based on candle closes and from the March 2025 high based on candle closes. After that, we bounced off this level and went sharply down. Accordingly, now both levels have been tested and technically Bitcoin could very well move somewhere around here to the lower boundary of the range. But it was stopped by the 50-day moving average, which is also shown in green. And as long as it hasn't been broken, we still have a chance to see a bounce upward. What supports the case for this bounce? Well, first of all, typically when there is an important technical level, and it gets broken, usually it gets retested before the price continues its upward movement. Or there's a second scenario. The level was broken, the price comes back, and then continues downward. Such a breakout is called a false breakout. So we don't know yet whether the recent move through the 50-day average was a false breakout or a real one. Nevertheless, some factors still point to it being a real breakout. Why? Notice that if we remove all the markings, we see that the lows are consistently rising, and along with them, the highs are also consistently increasing. This is very clearly visible on the weekly time frame. So if we look at all of this up close, we can see that along the 100-week moving average, both the lows and the highs are rising. And we have both the prerequisites and technical reasons to move into the area of $101,500, where the 50-week moving average is located. But according to formal indicators, we still have a short situation here until the candle from November 17th is absorbed, but that's already a weekly candle. For this to happen, we need to close above the level of $94,261 on the weekly time frame. Let's look at the monthly candles. What do the monthly candles say? The candles indicate a tendency toward a decline. Why? Because we had a multi-month sideways trend. In November, we broke down from this sideways range and got stuck in another sideways movement again. But the November candle is very likely to continue downward, updating November's low. At the same time, it's not forbidden to move to the middle of the November candle as a correction to the decline. That's around $99,000. And even to its base, that's the area of $110,000. So you need to understand that even a rise to $110,000 by itself is not yet a guarantee of a global reversal. Only a full engulfing of the November candle on the monthly time frame could reverse the trend back to upward. But we looked at the situation on the stock market, and there it's definitely not in favor of growth, although growth is not out of the question. Now let's see what we should expect on the daily candles. On the daily candles, we need to wait either for an engulfing of yesterday's candle, only a quality engulfing, so that the candle that engulfs it has a large body and a small upper shadow, or the closing of the daily candle below the 50-day moving average, and that at the very least opens the way down for us to the lower boundary of the range around the level of $84,250. And with the potential for a move lower, if we try to set global targets, there is such a rule. If the price of a financial instrument trades sideways for a long time, it tends to break out by the width of that range, either up or down. So we take our local sideways range, measure its width, and it's 10% from bottom to top. And then we look, if we go up from its upper boundary by the same amount, that will be roughly the 300-day moving average, and that's $103,000. Let's mark this level. And if we go down, meaning a breakout or exit from this sideways range happens downward by the same 10%. Now it's 10.2, so we've marked it. So the target level for a decline would be around $77,000. Accordingly, a breakout at this point should bring us there, somewhere around here. A breakout at this point, there's already a cross marked, should bring us somewhere around here. And again, we can only talk about shorting if the daily candle closes below the 50-day moving average. For now, it's a sideways market with no clear priority. We're basically in the middle of the range and could break out in either direction. We're waiting to see how things develop, waiting for new updates, but from the perspective of weekly candles, it still looks like a move toward the $100 to $102,000 area is likely, which I've been saying for several weeks now. But I emphasize, on a global scale, there's a very high probability that we'll update the November low around the $80,000 mark, and potentially we could go down to $75,000 or even significantly lower. Subscribe to the channel, leave your comments, and give likes or dislikes. The next review will be on the S&P 500 index. See you there. Goodbye.